Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Greg Hardiman, Managing Director at Crescent Capital. Greg, I really appreciate your time. Thanks for coming on the show. Looking forward to our conversation.
Thank you so much, Todd. Delighted to be here.
So, a lot of our discussion is going to focus around GP finance. And so, for the audience's purposes and maybe even a little bit of mine, can you clarify kind of what GP finance is and how that might differ from some of the other terminologies that, people might hear in the fund finance world these days?
Absolutely. And I will say, as an aside, it's extraordinary how much fund finance content you've had on your show, which is indicative of how far the space has come over the past few years. But to focus on GP financing specifically, to put it very simply, we are financing or lending to the general partner itself. And that can be the private equity firm or the management company. It can be the senior partners of a sponsor. We really view those two cohorts in a lot of cases interchangeably, particularly in the middle market. And we're helping them to address the growth needs, the capital needs that exist within their business itself. And that can span reinvestment, it can span generational transition and succession planning. We see both of those as primary drivers to the opportunity set and the need, which I'm sure we'll cover.
Mm-hmm.
And then as a lender, we're thinking about the assets and cash flows that the general partner holds directly. And we think about the pillars of those assets really being the commitments that they have across their funds, the management fee stream that they're earning across all of their funds under management today, any they raise in the future. And then to a lesser extent, the carried interest entitlements across their vehicles. As a lender, we tend to focus more so on the mature assets and recurring cash flows within the general partner.
So what are some of the motivations and need for this type of capital? And maybe when answering that, can you give us kind of a sampling of kind of what does this area of the market look like? Are there mostly non-banks playing this role? Are banks lending to these GPs? I mean, what does this area of the market specifically look like?
Sure. I will say it is an ever evolving spectrum. And even when we frame GP financing, we have an approach and a profile that makes sense for our capital base, and we think offers material flexibility to the sponsors as they look to manage and grow their firms. But there are certainly different flavors even within GP financing itself. To maybe paint a broad picture, when you think about the capital structure alternatives for a sponsor, you have a spectrum ranging from debt to equity, as a capital structure would for any company. On the equity side, the traditional source of capital and the most, I think, commonly understood and appreciated is selling a minority equity stake or a GP stake. And that is an area of the market which has become mature and developed over the past decade. We see GP financing as having the distinguishing features of one being non-dilutive to the ownership of the firm, and also non-permanent. It's designed to repay over time naturally through distributions from the sponsor's assets and portfolios. And then it can be replicated over time as needs and circumstances change. And then further, I'll say lower on the debt spectrum or risk return spectrum, you have traditional sources of financing from banks. That can be private banks that are lending to partners, individuals at a firm on a personal basis to help them finance their GP commitments. And for many sponsors, and certainly in private equity, but this applies to other asset classes as well. The private bank option has typically been the form of financing that they start with as they're getting going. So that's sort of the landscape. And then within GP financing, as we think about it, there are non-bank participants that are private credit managers, as we are.
Hmm.
There are insurance companies that play within a different spectrum of risk return. So again, it is an increasingly complex web out there.
And what are some of the other alternatives that GPs can use? I mean, you mentioned GP stakes. I presume that's an alternative. What are some of the other alternatives that exist for GPs?
Sure. And we often position GP financing as an alternative or complement to these other sources of
Got it.
capital. And whether we're an alternative or complement is in some ways dependent on where the sponsor is in their life cycle. Right. And if you have a group that is very mature, they may have been around for decades. It's possible that they already have minority shareholders at their firm. They may have sold, and this is just an example, right? But they may have sold 20% of their equity ownership. Time has gone by, new capital needs have arisen. They're raising new funds. Individuals within the organization have changed, and they don't want to take on further outside ownership. In private equity, in particular, we believe it's important to have a critical mass of ownership held within the sponsor itself, particularly for these middle market organizations, where there's a high degree of alignment with the next generation within that firm to
Mhm.
over time take on more ownership and the incentives that come along with it.
So tell us a bit more about Crescent. What's your remit at the firm? Has Crescent always been in this space? I know you and I believe one of your colleagues joined fairly recently. Tell us a little bit more about your role and Crescent overall.
Sure. First on Crescent, we manage just under 50 billion in assets. We focus on corporate credit, specifically non-investment grade corporate credit, and that has been the focus of the firm throughout its history. We were started in the early 90s, developed as both a private credit and a tradable credit organization, but today the capital base is roughly three-quarters private credit with distinct direct lending teams and strategies across the middle market, both in the US and Europe. So, from our perspective in what we call GPLP Solutions, which is the group that I came on board to help build and lead, we really sit as a product specialist interfacing across these direct lending teams with a view to leverage the relationship access and also institutional insight we have on both middle market sponsors and their portfolio companies. And frankly, that synergy with the platform and the strength of Crescent's presence in the market as, in our view, a trusted partner both to sponsors and allocators was a really exciting element of being able to come here and put this all together.
What are, I've talked to you and you referenced obviously the fund finance content here, and I've talked to a lot of folks in the fund finance market over the 40-ish episodes we've done here. Um, what are some maybe the broader market dynamics that are making, fund finance and particular GP finance, GPLP solutions so compelling right now? I mean, is it the liquidity issues that LPs are having? with some of the the holdings they have? I mean, what are the growth of private credit? What are some maybe those broader market things that are happening right now?
Yeah, there's a few dynamics at play, and I'll touch on both the allocator perspective and the sponsor perspective. And ultimately, what it comes down to is there's an opportunity set and a need, and arguably a gap in the marketplace where we feel that Crescent is very well positioned to help support the platform growth of these sponsors, develop creative financing structures that we think can deliver a balanced and stable profile to investors in a niche which, in our view, remains undersaturated with a large degree of white space in front of it, and where the level of awareness and adoption in the marketplace amongst the users, the sponsors, has entered a phase where the opportunity set has become deeper, the demand and activity is increasingly visible, and where we believe that middle market in particular has a relatively more limited range of capital structure alternatives to consider versus the largest platforms, and where we believe we can be a holistic partner to these GPs ultimately. The other point that I would make on the allocator side is we do see a trend towards thinking about satellite allocations within a private credit portfolio. Many institutional allocators at this point have an established, mature allocation to traditional private credit or
Hmm.
direct lending.
Yep.
There are numerous flavors and sizing segments to contemplate. We do see a lot of interest in thinking about niche strategies to add around that mature allocation, where GP financing is an area that we think it's differentiated by the fact that you tend to have diversified collateral pools supporting each investment rather than underwriting to single asset risk fundamentally in direct lending, where we believe the alignment between the lender and the borrower is unique, given where you sit within the organization of the GP and across their portfolio, where the return profile tends to be both contractual and fixed in nature, which can be a complement to the largely floating rate structure within traditional private credit. So there are a few dynamics at play ultimately that we think drive this to be an interesting area to explore on both sides.
Is there a a specific type of sponsor or fund profile that's like, hey, here's our sweet spot. It's this AUM or
Yeah,
this type of track record. You've mentioned middle market, I think two or three times in your answers
sure.
through the conversation here. What does that ideal target look like for Crescent?
Yeah, it is. The middle market is a broad definition, and everyone cuts it
Feels like it's
a little
changing
bit
too.
differently, right? And traditionally at Crescent, we would define the middle market based on the size of the portfolio companies held by the funds in that space, generally in terms of EBITDA, where lower middle market, think sub 50 million in EBITDA, core middle market, perhaps 50 to 150. But then in our world, in the GP Solutions world, we're thinking more so about the size of those sponsors and their funds under management. So for us, the lower middle market can encompass groups managing anywhere from 2 to 10 billion in assets as a rough guide. The core middle market can be anywhere from 10 to 50 billion plus. There are fairly scaled platforms even in that space. Our focus is across that spectrum. That's where we believe that Crescent's relationships and access and insight are deepest. That has been the focus of the firm throughout its development.
And when
And
it
then in
comes to,
term,
sure, go ahead.
sorry. when we think about the characteristics that we look for,
Hmm.
so more so than the pure size of the group, we're focused on how institutionalized the sponsor is, how well governed they are, how many key decision makers they have within the organization, how deep and scalable their investor base is, how underwritable their exit track record is. We take a holistic view ultimately. We need to think about the profile of the sponsor itself, and they are ultimately the steward of the portfolio companies and our counterparty in a financing. So it's very important to have confidence around the strength of the organization fundamentally. We also have to think about their sector focus, their approach to acquiring and capitalizing companies, the relative balance of exposures held within their funds. So it is multi-layered in nature when we assess situations.
And then you obviously referenced underwriting there. I mean, ultimately, what are the financing supported by?
Absolutely. Our focus is on the GP commitments that the sponsor is making across their funds. And a common catalyst for a GP financing can be the sponsor is raising their latest flagship fund. They are seeking to make an outsized commitment into that fund. In our observation, that is often between 4 and 8% of total fund size, so substantial
Mhm.
investments. And we are thinking about the existing assets, the more mature commitments and portfolios as a starting collateral base, as we would describe it. And then the capital, in a lot of cases, is being used to help fund capital calls for the latest vintage. So there's often a dynamic where the underlying portfolio composition becomes more diverse during the life of the financing. And so we think about the GP commitments really in terms of what they represent, underlying portfolio companies, and then assess those portfolio companies much in the same way that we would as a senior direct lender directly to those companies. We also like the management fee stream and the recurring and typically fairly visible nature of it. In private equity, when you close a new fund, if you're charging fees on committed capital, you have a fairly good sense of what the revenue is going to be
Mhm.
over the next several years. We find that in the middle market, it is often more practical as in a GP financing structure to include a portion of the management fees. A reason for that is we are more commonly working with the principal shareholders of that private equity firm, and we may be their sole financing partner to their franchise. So there's greater latitude to think about what the collateral pool will comprise, if you will.
That actually brings up a follow-up I was just thinking of in terms of additional lenders. Do you guys do everything bilaterally? Do you work with others, so to speak? I mean, what does some of those dynamics look like?
Yeah, GP financing is a space where, and we touched on this earlier in the conversation, there are different approaches. There are approaches that are more credit oriented in terms of the design by the lender and the return profile. There are approaches that are more equity oriented and perhaps more akin to secondaries. Um, these facilities can be very bespoke. There is an intimate relationship between financing provider and sponsor. In the middle market, and frankly, this comment is applicable across the space, although it is a market which is evolving and institutionalizing fairly rapidly. But we view it primarily as a bilateral, directly negotiated sole lender type market. It's not to say that we'll never partner up with one of our peers, but primarily see it as being bilateral.
So most of your referencing to GPs have certainly been around PE sponsors. Are GP financings relevant for other types of fund managers? Private credit, infrastructure funds, growth funds. I could probably think of more, but maybe go a little bit beyond the typical PE sponsor that you've been referencing.
Sure. We do focus on private equity buyout as that's where we believe our relationship network and origination engine is strongest and where we feel the most comfortable assessing the underlying exposures. GP financing is and can be applicable across the entire private markets space. We would argue that to look at an area like growth or venture, you need to have defined expertise and presence in that market to be an effective lender. Um, there are needs and uses in real assets, infrastructure, and real estate. You do see certain peers casting perhaps a wider net in terms of underlying asset class. But our focus is on private equity buyout. And frankly, we see the reinvestment related demand associated with large commitments made by the sponsor into new funds as being more significant than some other asset classes. A great example would be private credit, where it would be fairly uncommon in our minds to see GP commitments in the 5 to 10% area. And then ultimately the cost of capital and return on assets equation needs to work on both sides.
What would you say is your, I guess, main competitive advantage? I mean, I've heard you say, certainly the bespoke, bespoke nature of the deals, knowledge of the space, relationships. You guys have kind of identified this nice niche. I mean, where would you say is your, competitive advantage, where someone would say, all right, I'm going to choose Crescent versus maybe someone else?
Yeah, we believe it's a combination of sector or niche focus and having structuring experience specifically in GP financing combined with relationship and platform resources. It's the full combination. I think it's difficult to distill down to one factor, which will ultimately be the most helpful in helping to drive success. But GP financing is a niche where we believe it's imperative on the financing provider to be heavily outbound focused and ultimately taking responsibility for helping to drive and create their own opportunity set. Not every organization is built and has the resources in this area to operate in that way.
Now, you mentioned early on in the conversation about kind of the evolving nature of the fund finance and even the GP finance market. Are you starting to see some newer innovative structures come in? Obviously, it feels like, at least from the outside looking in from our perspective, there's certainly more structured credit in fund finance than there probably ever has been before. Obviously, private credit has certainly impacted the market. Do you see a securitization angle in the future to this space? Is there too much of a bespoke nature here? What are maybe some of the things that are happening maybe today or signal that might change where this market is going in the next few years?
I do think there is an interesting convergence between private credit, secondaries, and structured products happening simultaneously. I think you've covered the CFO or collateralized fund obligation segment on your show.
Yep.
That is an interesting development. It's more so relevant for private credit and secondaries managers, but in some ways, certain types of CFOs can be viewed as a form of GP financing or linked to a GP financing need and use case. As the market develops, having tranche structures perhaps I may go as far as to say securitization, but I think I would sort of view that on a spectrum a little bit, and I think in GP financing it will be incremental, and the more structured solutions, securitized type solutions, at least initially, will probably be focused on the upper end of the sizing segment in
Yeah.
terms of GP profile.
If you had to say, the outlook for the GP finance market in, kind of one or two themes, what do you think they would be?
I'll go back to some initial comments: reinvestment and balance sheet building, and generational transition. With generational transition being a focal point in the market from sponsors, their limited partners, and also solutions providers, where that's a need that's not going away.
Hmm.
It is arguably an area where not every sponsor is thinking ahead in terms of decades of how to make a roadmap for generational transition, and where we think solutions can help both incentivize and strengthen the organization, give more comfort to limited partners, so ultimately be a win-win. This is not just over the next 12 months, frankly, a multi-year dynamic.
Before getting into the final question of these, then we'll end with some fun questions. We've certainly been talking about the growth and some of the positive things in the space. If there was one impediment that you think could impact this market, what could it be?
It is a market which is not what we would describe as a flow market. It's one where, in a lot of cases, there's a dialogue with a sponsor that can be months, sometimes years. It's not every day that there's a catalyst for a GP financing solution or one of the distinct capital structure alternatives we touched on
Mhm.
early on. So it's a space where, to be effective, we think you need to have a long-term view in creating your opportunity set. It's not a space where we believe you can you can push deployment over a monthly or quarterly basis in a predictable and fully scalable way. And frankly, some of those features are linked to why we find the niche compelling to begin with.
So, final question of our at least serious questions. Yeah, how do you expect the space to evolve? Say over the next 3, 5, even maybe longer time horizon. Where do you see this space going?
Yeah, I think a continued theme around adoption by sponsors. I would say the past 5 years was one of growing awareness and education. The next 3 to 5 years is adoption, where firms that have successfully utilized GP financing may become repeat users, think about it as in some ways a permanent part of their capital structure. There are also plenty of organizations that may be thinking about it for the first time. As a participant, that's a favorable trend and ultimately growing the opportunity set. Going back to your point and question around securitization and other developments that are either directly linked or adjacent to the market, I think that the range and just different types of solutions out there for both for GPs and LPs, think fund finance and secondary space broadly, will only continue to proliferate. It makes it a pretty exciting space to watch and be a part of.
So, some final fun questions, a little bit of rapid fire as we end here. Favorite sports team and or hobby?
It is the time of year where snow sports are on the mind. So I'll say skiing, or more specifically, snowboarding.
One surprising thing about yourself.
When I was growing up, I thought that my career track was going to be through my family's motorcycle dealership, which in hindsight, it's amazing at how your perspective of the world and directions your life can take evolves, as you mature.
One book you'd recommend reading.
I'm going to stick on the skiing theme. Freedom Found by Warren Miller. I think it's a fascinating tale of defining success as you measure it in your life, and ultimately living life to the fullest.
Most exciting part of your job.
It's I'll admit I'm a self-described deal junkie, if you will. Taking a conversation to an idea on the back of a napkin to a successful partnership creates a lot of gratification and reward personally. I find that the bespoke nature of our space is what makes it so intellectually stimulating.
Then final question, given that we are in the holiday season, do you have a favorite holiday movie?
Christmas Vacation.
That's my favorite. So
Easy answer. I'm gonna fire it on perhaps this evening.
there you go. Perfect way to end the week, and perfect way in my mind to end the episode. So Greg, I really appreciate your time. Thank you for joining me today, and obviously continued success to you and the team at Crescent.
Thank you so much, Todd. It was a pleasure.
Thank you. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.